Hey, what's up, my friend? In today's episode, right, we'll be discussing on how to avoid false breakout. I know that hurts, right? I know you're always, getting caught on a false breakout. So let's talk about this. So here's the thing, right? Whenever the market breaks out higher, there's always this thing in you that tells you it's time to buy, my friend. And then you buy. The next thing you know, the market reverses and you get stopped out. Okay, so the lesson here is this, is that whenever you notice the market makes a huge rally, a huge breakout, candles after candles, they're strong, they're bullish, right? It probably means it's too late to enter the trade. Okay, and here's why. When you buy, right, after the market has made such a huge move in a short period of time, the first thing you'll encounter is there is no logical place to put your stop loss. Right, because the market made such a huge move, right? If you want to set a proper stop loss, all right, you got to look left and you realize that the previous swing low is so far away. So there's no logical place to put your stop loss because the nearest market structure is so far away from your entry price. So what would traders do? They'll say, but Rayner, the price is going higher. I'll just, get on board the trade and quickly exit for a quick profit. Yep, that is their mindset. Or rather, that is my mindset previously when I was trading in my early years. And they would buy. And where would they put their stop loss? They know risk management. They know they have to put their stop loss. So what they do is they just set their stop loss at any random level, right? Like maybe, 50 pips away from their entry. Or $2 or $3 away from their entry if they're trading stocks. And then what happens? Well, after market make such a huge wave up higher, it needs to pause, it needs to retrace, right? So the market pulls back and it eats their stop loss and they wonder, man, why does this always happen to me? Well, that's because you set your stop loss at a ridiculous level because you're chasing the markets, right? So this is how traders, right, they get caught on a false breakout. They keep chasing the market. So now, what should you do then, right? How should you trade breakouts then? Well, I got a couple of tips for you. Number one, don't chase breakouts. Instead, right, wait for the market, right, to show you signs of strength. What do I mean by this, right? So, for example, I know you're looking at your support resistance level. Let's say you want to buy breakout. You're targeting the resistance level. Don't just buy breakout out of resistance because not all breakouts are created equal. The type of high probability breakouts that you want to trade are those that shows you sign of strength. For example, right, you see a series of higher lows coming into resistance. So if you imagine that, right, that looks something like a ascending triangle. The price keeps approaching resistance. However, every time it bounces away, it forms a new higher low, approach resistance, bounce away, a new high low, and then approach resistance once again. So you can imagine that there is this coil over here forming at resistance, right? Telling you that buyers are willing to buy at this higher prices. And this coil cannot hold on forever. So what usually happens is that more often than not, the price breaks out higher as the buyers keep coming in at these higher prices, and eventually, right, the market cannot take it anymore and it has to break out. And chances are, more often than not, it breaks out higher. So those are the type of breakout trades that you want to trade, right? Is what I call, again, this one is a sign of strength, right? Looking to buy breakout of resistance. You want to look for higher lows into resistance. And if you think about this, right, your stop loss now can just be below, right, the previous swing low. So if you imagine, right, there is a series of higher lows into resistance, you can set your stop loss just below the previous swing low. Or even, right, you can actually connect the lows together and form somewhat of a trend line. And it has set your stops, right, below this trend line. So can you see that, if you don't chase the market, if you let the market show you signs of strength, you now have a much more, you have a logical place to set your stop loss. Okay? So that's the first thing, right? Look for a sign of strength, right, to buy breakouts. And if you are looking to short breakdowns, then look for a sign of weakness. And it looks something like, a series of lower highs into support, otherwise known as a descending triangle. So now the second technique that I want to share with you is what I call a build-up. So a build-up, right, is basically a tight consolidation that you see on your charts. So often traders ask me, hey Rayner, how many candles is a build-up, man? It's pretty hard to give a number, but if you really want to put a gun in my head and ask me, I would say look for at least a 10 candle build-up where, it's a very tight consolidation on your charts, right, and it's a range of at least 10 candles. So if you see a build-up at resistance, what this tells you is that the buyers are willing to buy at these higher prices because they know that the price is at resistance, right? This is an area where technically sellers should be around, right? And the price should, come down lower from it. But if you see a build up at resistance, it's telling you that buyers are willing to buy at these higher prices. And this, again, is a sign of strength. Okay? And when you look for a build up to form, right? Again, you can now set your stop loss below the lows of a build up. You have a reference point that you can use to set your stop loss. And another quick tip for you is that if you want to trade build up, what I realized is that the market can really go in either direction, up or down. But if you're trading with the trend, imagine you're trading in an uptrend, price is at resistance, there's a build up form. What happens more often than not is that the price tends to break out higher as well. So in other words, right, you also want to take into consideration, right, the trend of the markets that you're in. Okay, so these are a couple of techniques, right, that you can use to avoid false breakout. I hope it helps. And with that said, I've come towards the end of today's episode. If you've enjoyed it, hit the thumbs up button, subscribe to my YouTube channel, and I will talk to you soon.